The main thing about cash flow is that we got to have an understanding about the yields, the gross yields that we have in different parts of Australia. That's very important before we start our journey. So you have to be careful about these markets. So if you buy an expensive property for, let's say, 800,000, there can be a significant land tax component there that can eat into this gross yield. For the other areas, today I want to talk about the three fundamental pillars that are crucial when you're buying an investment property. So whether you bought a property in 2010, whether you're buying a property in 2025, or whether you're going to buy something in 2040, these three pillars are going to be crucial in making sure that you buy a good investment property. The three pillars are growth, cash flow, and risk. So if you are able to balance those three, you can continue to build your portfolio slowly and steadily. If you get the balance wrong between these three, then that could be the end of your property investment journey and you can't continue to buy properties. So these three pillars become really important, and that's exactly what I'm going to dive into in this video. So today's video is slightly different to the usual formats that I do. I'm going to do something on the blackboard, and I really hope that I can explain things clearly over here. For those of you who don't know me, my name is Jadhu Srikandan. I'm a buyer's agent for property investors, and I buy properties all around the country using a data-driven approach. So if you want to work with me, then go to our website, propertyframeworkbuyersagency.com.au, and book a session with me there. So what we're going to do today is going into each one of those pillars. First, we'll start with growth. Then we'll talk about cash flow, and then we'll talk about risk profile. We'll go deep into each one of these concepts so that by the end of the video, you know exactly what you need to look out for when you're buying an investment property. Now let's talk about the first pillar, which is growth. So when I'm talking about growth, we have to understand the whole of Australia. The first very basic step is just at least get an idea of the different price points in the different parts of Australia so that you know whether or not this market would suit your budget. So how do you get the price points in different parts of Australia? At least the entry-level price points. You do this by having a basic CoreLogic subscription. You just subscribe to CoreLogic. They send out monthly reports, they send out quarterly reports, which talk about the different regional markets, which talk about the capital cities, and you get a fair idea about the median prices around the whole of Australia through that. So that's the first stage. Alternatively, if you want to make the process faster, you can get a paid subscription like Hashtag or something like that, where you can look at different markets and understand the entry-level price points. So understanding the entry-level price points in different areas is crucial because you have to know whether or not that market fits your budget. So that's the first stage. Now, the next stage is clearly to understand, okay, this area, it fits my budget, but should I buy there? How am I going to assess whether we should buy there? And that's why I have kind of tried to simplify this here. I've pretty much put the whole of Australia here, except for Sydney. Sydney is not included, but every other major regional center and capital city is somewhat covered here. And the purpose of this is to really understand where in the growth cycle each area is positioned. So we know the entry level price point. Now we're trying to figure out where is this position? How has this performed? Where is this moving towards? So that's what I'm trying to get at here. Now let's look at this first chart here. This first chart is talking about the markets of Perth, Adelaide, Brisbane, regional Queensland, regional Western Australia, regional South Australia. Now the profiles for them are exactly very similar. The levels of growth might have varied to some extent, small variations in the levels of growth, but the growth profile is exactly like this, where we see a stagnation from 2015 till about 2020, and then from 2020 onwards, we're seeing prices rise. Okay, Perth was slightly different because we saw a decline in values in Perth, and then Perth went up in value. So these markets, you can see from 20 to 25 have been rising up in value. So what do you expect in these markets? You're going to see hot market conditions, a lot of competition, and you can see that it has already gone through a significant level of growth. So 5 years of growth. Now let's look at the second group here. I hope this is clear. So this is regional NSW, regional Victoria, regional Tasmania, and then Hobart. So there's one capital city here as well. So if you look at the profile for these markets, again, it's very similar. From 2016 till about 2022, there was rapid growth here. There was very good growth here. And then from 22 till about 25, there was a bit of a stagnation. Some markets actually went back by about 10%. Some markets were stagnant. Some markets went up by about 10-20%. But overall, I would call this phase a stagnation phase between 22 and 25. And these markets are now starting to have some green shoots. There's some growth starting to happen here. So that's regional NSW, regional Victoria, regional Tasmania, and Hobart. The next one is Melbourne that I put over here. Now, Melbourne is very interesting. So between 17 and 22, not much growth. And then from 22 to 25, further stagnation. So Melbourne has been performing poorly between 17 and 25. And it's only the total growth between here and here is around 30% for Melbourne. So that's why most people are saying that Melbourne is undervalued and hasn't grown as much. And finally, we have Darwin, which kind of went back from 2015 to 2020, had a bit of a rise, a stagnation, and now we're starting to see Darwin starting to move up in value really fast. This is starting to move very fast in Darwin. So this is pretty much the state of Australia, right? We've mapped it out into 4 different graphs here. It really depends on you, on where you want to go. Like if you want to get into a hot market, you might get some short-term growth, but you're competing with a lot of investors. And in these markets, we are starting to see vacancy rates rise in some of the suburbs because there's a lot of investor activity. There's a lot of pressure in these markets. So that's why investors are buying in large numbers and increasing the vacancy rate. So you have to be careful about these markets, which is purely driven by investors. That's the first stage. So what I'll be very cautious of is once I understand the growth cycle. So let's say I'm someone who has 600,000 and let's say I want to get into a market that has green shoots emerging rather than into a market which is well into the growth cycle. So let's say I want to go into this market. Then I go into these individual areas and then try to study them. And that's where we have different aspects coming in, like the cash flow, the risk profile. We got to study them from those angles as well. And that's what I'm going to go into next. So the next pillar that we are going to look at is cash flow. So cash flow is basically rental income minus expenses. So we want our cash flow to be manageable while we build out our portfolio. So the main thing about cash flow is that we got to have an understanding about the yields, the gross yields that we have in different parts of Australia. That's very important before we start our journey. So here I've listed out basically some of the rental REITs for the major markets in Australia. Again, the exact markets that I spoke about last time. So we have, if you look at Brisbane, like if you look at areas like Logan, Ipswich, you're going to get yields of around 3.5 to 4%. Yields have compressed here from about 5 to 6%. They've dropped till to about 3.5 to 4%. Regional Queensland is going to be 4.5 to 5%. But we're seeing a yield compression here as well. It was 2 to 3 years ago, you could get 6.5% yields, but now those have dropped between 4.5 to 5%. Next is Adelaide. In Adelaide, we're seeing yields around just under 4%, 3.5 to 4%. Again, these are the ones you're going to find mostly in the affordable segment of the market, not the expensive segment of the market. The yields are listed here. It is generally what you would find in the affordable segment of the market. Regional, let's say around 4 to 4.5%. Again, yields have compressed here. In Adelaide, you could easily get about 4 or 5 years ago, you could get close to a 5% rental yield. And now that's dropped between 3.5 to 4%. And the same for regional South Australia. Then we go to Perth. In Perth, potentially we should be able to get close to 5% in one of the more affordable markets like Armadale, Rockingham, and so on. But in some of the markets, yeah, it's been dropping to about 4.5%. This we used to be around 6.5 or even 7% sometimes, maybe 3 or 4 years ago in Perth. Regional WA is 5%, again has compressed from about 6.5%. Now Melbourne is an interesting one. We see that Melbourne is around 3 to 4% rental yields generally. A more affordable segment of the market like areas like Melton, you should be able to get around 4%. But generally, the most parts of Melbourne, you're looking at closer to that 3% or even sometimes lower. The interesting part about Melbourne is that over the last 3 years, we've had yields increase by about 0.5%. So in these 3 areas, we've had that yield compression. Whereas in Melbourne, we've had yields actually increasing. And that's because the prices didn't move up as much. And therefore, the rental demand was picking up and the yields were increasing. Similarly, with regional Victoria, we're seeing around 3.5 to 4.5%. It depends on which part of regional Victoria you're looking at. The yields can vary. And there hasn't been too much yield compression here because regional regional Victoria, again, hasn't seen too much growth over the last few years. And then finally, Hobart, in the really affordable segment of Hobart, like areas like Glenorchy, Claremont, you could get close to a 5% rental yield. So that's the affordable part of Hobart where you could pick up properties between 500 to 600,000. And then regional Tasmania, you have areas like Launceston, Burnie, where we're looking at a 5% yield. Again, there hasn't been too much compression here too, because prices haven't moved as much. So with this, you get an idea of the cash flow you can expect from each property. Bear in mind that these are gross yields, gross rental yields. For example, in regional Queensland, you have major weather events, flood events, and therefore you have higher insurances, you have higher council rates, and that will eat into your cash flow. Even though the gross yield is good, the net yield might be much lower in regional Queensland. Then we have areas like in Melbourne, regional Victoria, we have land taxes that come into play. So if you buy an expensive property for, let's say, 800,000, there can be a significant land tax component there that can eat into this gross yield. For the other areas, I don't think in the outgoings there are major expenses. They are pretty standard. It's mainly regional Queensland and Victoria that you have these additional costs coming up. Particularly even Brisbane as well. Your council rates are generally higher in Brisbane than other parts of Australia. So understanding these gross rental yields and the net rental yields, you can understand your cash flow, and by understanding your cash flow, you can manage risk. Having said that, let's say you buy a $600,000 property with a 5% rental yield today in Australia. You're still going to be negatively geared by around 12,000 per annum. Total rental income is not being able to match total expenses. So being negative cash flow by around 12,000 per annum, you have to assess of how many of these properties can you realistically hold, because that is one of the things that might slow down how you're going to build your portfolio. So cash flow, the second aspect, becomes really important. I think really understanding the differences between gross yields and net yields, understanding the rental conditions in different parts of Australia become really important. The other factor, of course, is we want to see areas where the rents are tightening up, where the vacancy rates are tightening. So when you're making an investment decision, we want to get into these areas where the rents are increasing, vacancy rates are tightening, so that, we have further rental increases, and that boosts our portfolio. So that's the understanding that you have to have about cash flow before you start your investment journey. Now, the third element that I want to talk about is risk. So this is the third pillar. Now, you could have bought in the correct market cycle. You could completely do a cash flow analysis and understand your cash flow. All that's fine. But then you also have to assess the risk of that investment property. What are the risks? How can this investment property hurt me in the future? That's what you're going to look at. And I want to use this with using certain examples. So the first one, as when you're buying your first investment property, we don't want to get into smaller towns, like smaller towns which have less than 20,000 population. There's not much economic diversification. The job market isn't too strong. We don't want to get into these kind of areas for our first property. When we are more comfortable, we've built out our portfolio, then we are more comfortable with these markets, and then we can get into smaller towns. But for our first property, we want to get into well-diversified, good regional markets, areas like Geelong, Ballarat, Townsville, areas like that, which are strong regional markets. We don't want to get into small towns for our first investment. The second thing, we don't want to buy into an area that's heavily reliant on one industry. Now, Darwin as an example. I've been buying in Darwin as well, but I understand the risks. Now, Darwin is heavily reliant on the one industry, the resources sector. So if that industry doesn't do well, the property market is automatically affected. But at the moment, we're seeing really good price growth happening in Darwin. So it makes sense to go there. But at the back of your mind, you should know that there is a risk involved there. And you should know when to sell off your property, because there is not that economic diversification that we really want in a long-term investment. Darwin doesn't have that. So you should be able to assess that risk. Next one is Townsville. Again, I have been buying in Townsville too, but then it comes with its risk. Townsville has major floods, cyclones, stuff like that. Insurance costs are higher, and that eats up into your cash flow. Even own occupiers will have to pay high insurances to buy a house in Townsville. So that should be assessed. When you compare Townsville maybe to another region like Gladstone, which doesn't have these weather events as much as Townsville, and the insurance premiums are lower, you can see that Townsville poses a slightly higher risk from that aspect. So weather events, risk of weather events, it is a risk, but you just have to make sure that you are understanding these risks. I'm not telling you that you should completely avoid these markets. It's just that you have to understand these risks and know what you need to do when something unexpected happens. Next one, the risk of high supply. So going into markets where there's a lot of supply. So area, I'm going to take a Truganina as an example. The vacancy rates in Truganina is like 6 or 7%. And I know a lot of new investors like to jump into these newer properties, but you will find that the property might be vacant for 1, 2, 3, even 3 months before you find a tenant. And we don't want to get into these type of situations. So avoid getting into these high supply areas. Ideally for our first investment property, we want to get into markets that are really established, doesn't have that surplus supply coming in. So we want to get into established areas. And the final one, we don't want to put too many eggs into one basket. So essentially, let's say we're buying in Melbourne's really popular now. We don't want to buy 3, 4 properties in Melbourne. I've covered this in previous videos because when that market goes through a correction, all our properties will go through that correction. We want properties in different areas so that when one area is not doing too well, the other one can support it. So these are basically the risks that you have to factor in. Like when you're buying investment property, we want to get into areas that are, the most important thing really is to getting into areas that are economically diversified, have strong job markets. There are no flood events ideally, and then we don't have those, extra supply coming in like Truganina, for example. We don't want that. Those are the type of markets we want to target. Again, we want to target areas that have a healthy population. The population is increasing, where there's interstate migration. People want to go into that area because of jobs, lifestyle, affordability. All of that has to be looked into. So essentially, all of this has to be balanced out. We want to find that sweet spot between growth, cash flow, and risk. If we focus only on growth and ignore cash flow and risk, that's not going to be good. If we only focus on cash flow and ignore growth and risk, again, that won't help us either. And if we're only focusing at that risk element, we just want to make sure that we're not buying something risky, then that doesn't help either. So you should be able to balance everything out if you are going to buy a good investment property. I hope you found this useful. I'm sorry if it wasn't very clear. I tried using the blackboard. I really hope I was able to explain some of the concepts here. So hope you found value in this, and I'll see you in my next video.